All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride today. We do have a great show lined up for you today. Today is episode number 455, and today's title is Top 10 Trading Rules. Today, what I'm going to be doing is I'm going to be sharing with you our top 10 trading rules that we have shared many, many times over the years with our members, as well as with our audience. You know, many times we've talked about these rules in the past, and I thought, based upon the feedback we've been receiving over the last many months, that this might be a perfect episode to kind of go back to basics and talk about the trading rules that we use and teach here at followthemoney.com. You know, I traded my first stock back in 1996. I traded my first option in 2002, and I have learned a lot since that time. I certainly stumbled into trading. I didn't have a good mentor, and I certainly didn't have any rules. And so when I first got started trading, I was a pretty big mess. And I was really driven by emotion much more than rules. I was really driven by, you know, the excitement of a gain, or then, of course, followed by depression of a loss. And I was just really kind of a wreck. I didn't really know what I was doing. I knew I wanted to succeed, but I just didn't know how. And over time, what I learned is that trading, you know, whether you're trading stocks or ETFs or options or crypto or whatever it is, if you don't have a basic set of rules that you follow, if you don't have a rules-based system, a rules-based approach, then you can really get yourself in trouble, right? And so what we want to do today is we want to talk about these top 10 trading rules. I think you're really going to enjoy them. We're going to go through them through the course of today's broadcast. And without further ado, let's get started. All right, friends, so let's get started with our top 10 trading rules we want to cover in today's broadcast, and we'll begin with trading rule number 1. Now, I want to just preface this by letting you know that we're really focused upon the topic of trend trading here especially, but particularly swing trading. So much of this is going to apply to swing traders, and let me define what that is before we go further. You know, obviously you've heard of day trading. Well, some of these rules will certainly apply to all types of trading, like day trading. Day trading is where you trade in and out of a stock or an ETF or a crypto or whatever, all in a single day. You're usually opening the trade and closing the trade all in a single day. That's not the primary focus we have here at Follow the Money. We are much more focused upon swing trading and position trading. Now, let me explain what those are very briefly before we begin. Swing trading is a different kind of approach. You're not trading in and out in a given day. That would be day trading. Instead, a swing trade, our typical swing trade ideas that we put out usually are about 1 to 10 days. You know, so you might hold a stock for, you know, a couple of weeks or so, just to take advantage of a near-term move. And so we call that swing trading. The rules that we're talking about today definitely apply to swing trading. And then also position trading, which is actually that's really what I've gravitated towards over the years. I consider myself a part-time position trader today. I don't day trade, rarely swing trade. I really focus upon part-time position trading. It fits my lifestyle, and my lifestyle today much easier than, you know, some of these other styles that require a lot more time in front of the computer. But these rules would also have application to position traders. And position trading, by the way, is basically a form of trading where you hold in terms of, you know, many weeks or usually months. So when I hold a position trade, I'll hold it for many months. And, you know, that actually works out well, as far as gains, because obviously the longer you hold something, the more potential gains you can make. That's not always true, but sometimes that's true. And so these trading rules are really directed towards swing traders, but they do have application for day traders and position traders. So with all that said, let's begin with rule number 1. And our trading rule number 1 here is to know the current market conditions before you trade, right? So before placing a trade, the very first question that I want to have answered is, which direction is the current market trend? So the reason why this is so important, and I learned this from William J. O'Neill, the founder of Investors Business Daily. He has a great book entitled How to Make Money in Stocks. And in that book, he does a great deal of research on trades over the last, trading activity and the price of stocks over the last many decades. And what he discovered was that historical data shows that 3 out of 4 stocks tend to follow the overall trend of the market. Now, we have a never-ending stream of financial news, but that really means little to me personally until I have seen the chart of the market's major index. So before placing a trade in the U.S. stock market, I think it's very important for you to know the current state of the major market index. If you're in the United States, that would be something like the S&P 500 index, right? So I examine the S&P 500 index chart in all relevant timeframes to fully understand the state of the broader market. Now, many of history's top traders have understood the importance of waiting for a general market uptrend to occur before they begin to pyramid their capital into the day's leading stocks. And when market signals a new uptrend, then that would be a time where you would begin buying or adding positions in leading stocks within the leading industry groups, within the leading sectors. And when the S&P 500 enters a new major downtrend, well, traders should react to that. They should begin to lighten up their exposure, locking in gains on long positions and raising stop losses. So if your goal is to earn money from the markets, then here's what you definitely don't want to do. You don't want to fight the general market trend. Instead, let the trend become your profitable friend. You've probably heard that before, to let the trend be your friend. Well, that's rule number 1. Know current market conditions before you begin to trade. Cannot stress that one enough. Now, let's move to rule number 2. Trading rule number 2 is to plan your trade and trade your plan. So most traders fail because they don't have a trading plan, right? And because they don't have a trading plan, they're held hostage by their emotions. Just like I was telling you earlier, that's really what drove me in those early years as a trader. And that inevitably leads to losses in the markets. Now, you may be surprised to learn that most traders do not have a plan or a strategy. Now, I can tell you that for sure after coaching many people over the years who want to learn how to trade. That's one of the things, and many people who have been trading, I was surprised initially to find out that many of them don't have a plan. Well, that's how I was when I first got started. So, and the reason why people don't have a plan when they trade is that many traders approach trading as a hobby, right? And therefore they don't invest the necessary time and energy to develop their entry and exit strategy along with a set of money management rules, such as using stop loss orders. And additionally, most traders don't review their gains and losses, so they're unable to learn from their mistakes and their failures. So without a consistent trading plan that includes money management rules, most traders are usually nervous about their trades and they lack confidence, and that leads them to second guess their trading ideas. And this, of course, explains why so many traders lose money in the markets. So by developing a trading plan, you can control your emotions and conquer your fears of trading. Put simply, trading according to a strict trading plan prevents your emotions from keeping you out of the market when you should be in it, and in the market when you should be out. So rule number 2, plan your trade and trade your plan. Create a trading plan that includes rules and strategies that you will use time and time again. And of course, always feel free to adjust those rules as you move through. And by the way, as I share these rules with you, realize these are my rules that I use myself and that I teach others. You may want to customize these rules or create your own rules, but I think that you'll find that many of these rules are rooted in a lot of wisdom because, I've learned the hard way over the years on how to trade. And so these rules kind of help me overcome some of those hurdles. Now, trading rule number 3, this one's very important, especially for those who are new, is to avoid stocks that trade on low volume. So personally, I prefer to trade stocks with at least 400,000 shares in average daily volume. Now, if the stock price is less than $5, which I rarely am going to trade a stock like that, very rarely, but if I did, then I would want that stock to have at least a minimum volume of 1 million shares traded on an average day. Now, remember that the level of a stock's volume provides us with an instant look at the current level of interest in that particular stock. So when a stock trades on low daily average volume, that is a big sign that there's less interest in that stock than there is in other stocks with larger amounts of volume. Now, it is true that stocks with low volume can carry a greater potential for larger moves. These moves are much more difficult to identify in advance compared to stocks that trade on higher volume. Stocks that trade on low volume are often more difficult to sell or liquidate than their higher volume counterparts. If, for example, a trader earns a nice profit on a low volume stock and then decides to sell the stock, well, it can take many minutes or even hours or even days to sell. It all depends on the amount of volume that the stock carries. So by the time the order is finally completed, the price could be higher or lower than the trader had initially, expected. So do yourself a favor and up the odds of your success by focusing your trading efforts on stocks that are more liquid with good and consistent amounts of daily volume. So trading rule number 3, avoid low volume stocks and ETFs. Trading rule number 4, a very important one here. Keep a trading journal. So over the past 25 years of trading, I have learned the absolute importance of keeping a record of my trading activity. Without a record or a journal of your previous trades, it's difficult to remember which strategies worked and which ones didn't. So all functioning systems need some type of feedback loop in order to make meaningful improvements. For example, employees of most companies must complete an annual performance review in which their boss sits them down and tells them what they've done well and what they can improve on. Well, your progress as a stock trader is no different. A feedback loop is crucial so that you can make adjustments and improvements. There's a definition of insanity that says doing the same thing over and over again and expecting different results each time. That's insanity. But if you trade securities without any feedback, I'd say you're bordering on insanity, especially if you keep seeing your trading balance decrease. So your feedback loop should take the form of a trading journal in which you record all of your trades, and after each position closes, you can return to the journal entry and discover what you did right and what you did wrong. And you may be surprised at what you uncover. And you can just get just like a little diary of some kind, or even keep it online. You can do it like in a spreadsheet, but just keep a trading journal that tracks your trades. And that way you'll have some sort of feedback loop so that you can make those meaningful improvements. Now, let's move on to trading rule number 5. And this one is very important. Always use stop loss orders. One of the most common trading catchphrases that you probably have heard is to cut your losses short and let your winners run. Put simply, this popular phrase emphasizes the importance of not selling a stock too quickly when it's rising, as well as not holding on to a stock when its price is tanking. Now, this may sound obvious, but it's often much more easier said than done. After all, if you're a trader, how many times have you sold a stock only to watch it continue rising in price, or held on to a losing stock only to watch it fall further in value? If this describes you, well, you can help break the frustrating and vicious cycle that this basically creates with stop loss orders. As the name suggests, a stop loss order or like a market or limit order, is a specific order type that instructs your broker to automatically sell your stock if it falls to a certain price as specified by you. So before I buy any stock, I first determine 2 very important things: my preferred entry price and my maximum loss threshold. Once I actually place a trade to buy a stock and the trade executes, I immediately place a stop loss order telling my broker to sell that stock if it falls below a certain price. And you can do the exact opposite on the upside. If you want to exit at a particular price, well, then you can place a stop order on the upside that allows you to sell that stock as soon as it hits that upper price. So trading rule number 5, always use stop loss orders. All right, so we've gone through the first 5 rules. Let's recap them real quickly. Trading rule number 1, know current market conditions before you begin trading. Don't fight the general market trend. Trading rule number 2, plan your trade and trade your plan. It'll help you conquer your emotions and your fears of trading. Trading rule number 3, avoid low volume stocks, right? When a stock trades on low daily average volume, it's a sign that there's less interest in that stock, so beware. Trading rule number 4 is to keep a trading journal. All functioning systems require a feedback loop to make meaningful improvements. And then trading rule number 5, always use stop loss orders. Cut your losses and let your winners run. All right, on the other side of this quick break, we're going to come back and we're going to talk about the next 5, the final 5 trading rules. We'll see you on the other side of this break. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to Follow the Money Radio, one of the longest running financial podcasts on the web. We began back in 2010, and what an honor it's been to serve you since that time. We're so grateful to have you here today on today's episode number 455, and the title, The Top 10 Trading Rules. So these are trading rules that we share with our members here that we actually have used ourselves, and we teach our students. So now let's continue on and talk about some more trading rules. We've already talked about many. We got 5 more to go. Trading rule number 6, pyramid into your positions, but don't average down. Now, this is a very powerful rule that we share with our members, and I want to explain this to you. One of the most important lessons I learned early on in trading was to never average down, but instead to average up. Now, put simply, averaging down is an old investing idea that says that you should add more shares to your trading position if the stock goes below your initial purchase price so as to improve your overall cost basis. For example, if you purchase a stock that you intend to trade at $50 a share, and then it immediately drops to $48 a share, well, the average down crowd would encourage you to add more to your trade. This is a dangerous idea, though, and directly conflicts with the pyramiding or averaging up strategy employed by many of the greatest traders of the past century. Now, while I do not mind using the averaging down strategy for long-term investments because I think that makes sense, when it comes to trading, absolutely, positively not. Instead of adding more shares when a stock that I am trading goes down, I want to sell that stock instead. When I buy a stock, I am speculating that it is going to rise, not fall, in price. Inversely, if the stock I have purchased rises above my entry price, it's only then that I will add more, right? So don't fall victim to buying more shares of a losing trade. It will not only hurt your trading account, it'll also set up a poor psychological precedent for the future. Instead, I encourage you to only add more shares or average up when you're right about a trade. This type of discipline will serve to magnify your gains when you are right, and it'll help you limit your losses when you're wrong. Again, I want to stress, averaging down for long-term investing, I understand that. That makes sense. But when you buy a stock at a particular price and you expect it to go up, I would encourage you to only add to that position as it goes in the direction that you expected. If it goes the opposite direction, that's what the sell button is for, right? So don't fall victim into buying more shares of a losing trade. Trading rule number 6, very, very important. We have a whole teaching on our probing and pyramiding strategy for traders. It is absolutely powerful. Our members have access to that. Okay, let's continue on now. Trading rule number 7. Now, this one, I don't think it's controversial, but I think it may be a little misunderstood. So let me try to be careful how I explain this. Trading rule number 7, and this is specifically for swing traders, not necessarily day traders and not necessarily position traders, but specifically for swing traders. Let's make that clear. The rule, trading rule number 7, is avoid opening a new swing trading position in the first 30 minutes of the trading day. So this is a rule I came up with about 5 years after I began trading. This was one of my first rules that I noticed. I began to notice an extreme amount of volatility in the first 30 minutes of every trading day. And after conducting some back tests on trading in the first 30 minutes, my results were astonishingly clear. I learned that I needed to avoid buying stocks in the first 30 minutes of the trading day. Now, you might ask why? Why would you do that? Well, from my own research, and this is my own research, and I could be wrong on this, and it may not apply to everything, but I think it really does apply to swing traders. At least it has for me over the years. I realized that the excessive amounts of volatility in the first 30 minutes of the daily trading session was due primarily to trade executions initiated in the pre-market hours, as well as many random market orders being filled right as the market opens. And so this onslaught of trade executions upon the market's open serves to temporarily distort prices. And so once the early spike in orders slows down, usually by the end of the first 30 minutes, the price action typically becomes more smooth and predictable, and the bid-ask spreads usually tighten a little bit, allowing for better trade executions. While I'll rarely add a new position in the first 30 minutes of the market's open as a swing trader, I do often view that time as a perfect time to sell, oftentimes because the prices are so distorted and a stock may run up quickly in the first 30 minutes only to come right back down, after that first 30 minutes. That can often be a great time to sell. In fact, my favorite time to buy stocks is in the final 30 minutes of the trading session, and my favorite time to sell stocks is in the first 30 minutes of the trading session. So that's an interesting rule that I've developed over the years. It works for me. It may work for you as well. Trading rule number 8. This one also very important. If you have a small trading account, which usually is the average, most people who are out there trading, they usually don't have a massive trading account. And that's probably good, especially if you're new. You really don't want to trade a bunch of money that you can't afford to lose, right? So when you're trading, you always want to focus upon being very cautious with your money. Number one rule, of course, out of all of these rules is to not lose money, right? But if you have a small trading account, trading rule number 8 here, consider options, not penny stocks. Okay, so after coaching many new traders over the years, I have found that most face the same problem, a small amount of trading capital. Right? And when you don't have much money to trade with, then these cheap penny stocks, and these are stocks that trade for less than $5 a share, and often on very low volume, they begin to look attractive to you because, after all, it seems like much more realistic to you for a cheap $1 stock to double than for like a $50 stock to double. But this reasoning is faulty, as witnessed by the number of penny stocks that fail each and every year. So if you have a small trading balance and you're tempted to focus your efforts on buying penny stocks, my recommendation is don't. Why? Again, because penny stocks are cheap for a reason, and they are much more likely to fall in price than to rise in price over time. You are much better off to invest some time focusing either on very well-known blue chip stocks or to focus, as I'm going to suggest here, on options trading. When used properly, options are far less risky than penny stocks and can give you exposure to higher quality companies for a fraction of the price. Put simply, new traders with small trading balances should focus on buying call options on high-quality stocks instead of risking everything on penny stocks. That's my opinion. And I've seen many people use options to be able to get access to blue chip stocks that maybe they wouldn't have been able to afford with a small trading balance. We have lots of options trading education here at Follow the Money for our members, so I encourage you to check that out. Now, let's move on to trading rule number 9. Trading rule number 9 here. Avoid stocks trading below a declining 200-day moving average. That one is a very powerful, very, very powerful rule. So the 200-day moving average, if you're not familiar with that, this line is a powerful metric that many financial institutions and hedge funds use to add into their trading algorithms. Now, most smart traders avoid stocks trading below their 200-day moving average. And basically what the 200-day moving average is just what it says. It's an average price of the stock over the last 200 days, or 200 periods. Usually, if it's a daily moving average, it would be 200 days. And that 200-day moving average is a very powerful metric, as I mentioned, for financial institutions and traders and investors. Many people look at that line. And so the caution here is that you want to watch out for stocks that are trading below their 200-day moving average, because that means that they're weak. But additionally, if they are trading below a 200-day moving average that is declining, that's even more alarming. And so there's really only a handful of situations where I would consider trading a stock that sits below a declining 200-day moving average line. One of those is if I'm seeking a stock to maybe buy a put on or sell short. I don't sell short stocks. I don't like shorting stocks. If I do want to short a stock, I will buy a put option. That's my preference. And then also, if the stock chart has formed a clear bottoming pattern and appears to be rising on strength. So maybe you've got a stock that has formed like an inverse head and shoulders pattern, or it's formed like a double or a triple bottom, and now it's starting to come back up, and it's still below a declining 200-day. Well, when you have that kind of setup, then maybe I might consider it. But again, I much prefer to focus my trades upon stocks that are either breaking out above the 200-day moving average, particularly on higher than normal volume, or a stock that's already above its 200-day moving average, as it's going to attract more buyers, in my opinion. It's tempting to trade stocks that are at or near their all-time lows. Believe me, I get it. But most bottom feeders rarely get lucky. In fact, trying to successfully buy stocks locked in a brutal downtrend is a lot like trying to catch a falling knife. Somebody usually gets hurt. Many traders have seen their trading capital get wiped out by chasing downtrending stocks further down in price. I prefer to trade stocks in clear uptrends, trading above a rising 200-day moving average line. It's a very important rule. Rule number 9, avoid stocks trading below a declining 200-day moving average. Now, we are now to our final rule of our top 10 rules, and it's rule number 10, and that rule is paper trade, paper trade, paper trade. Before using your own hard-earned money to speculate on Wall Street, I strongly advise you to first test out your trading plan on paper for a period of months, even years if necessary. Remember, this is a marathon, not a sprint. Far too many people come to trading looking at it as if it's a get-rich-quick strategy, and it is not, my friends. I can tell you this from a long time of experience, many years. Trading is difficult. And if you don't have a plan, and if you don't have, something written down, if you don't have rules, you're then you start putting real money at risk without understanding what you're doing, and then you're letting your emotions get in the way, and you're not doing your research. Man, you could really get hurt. So I strongly advise you to first test out your trading plan on paper for a period of months, even years if required. I had one student who took about 3 years of just fine-tuning his plan, paper trading his ideas. And after about 3 years, he began to use real money. And when he did, he kept the amount of money very low. I was very proud of that student. I think that's a very great way to do it. You may not take 3 years. It may take you, 6 months or so. But regardless, the point is that don't rush into this, because you're much more likely to lose money than not. I've heard the statistic, and I can confirm that 90 to 95% of new traders fail because they don't have a plan. They don't have strategy. They don't have rules. They don't paper trade. They don't really know what they're doing. They're ruled by emotions. They don't have solid rules. So in other words, when it comes to testing out your trading plan on paper, what I'm saying here is to act as if you're really trading and record those trades on paper. And when your trading plan tells you to sell, well, close out the trade on paper and check your results. In other words, you're never putting real money at risk here when you're paper trading. And no amount of paper trading, by the way, can prepare you for the raw emotions that you're going to experience when you're trading real money, but it can help you fine-tune your trading plan. So that's an important thing to keep in mind. Paper trading isn't the cure-all. It's not going to solve everything, and in fact, many times you're not going to feel the real emotions of putting money at risk. Nonetheless, it's going to help you fine-tune that plan. Even better than simply recording your imaginary trades on paper, commit to learning from both your paper trading successes and your failures. Now, once you place real money on the line, the experiences and the lessons that you have learned from months of paper trading, or maybe even years with your own trading plan, is going to serve to give you confidence in your decisions. Now, there are several free online paper trading systems that can accurately simulate the market's action and give you a feel for trading before you commit to your own hard-earned money. I know that even over at E-Trade, that's where I have a brokerage account, over at E-Trade, they have a paper trading solution. So you can actually, instead of actually having real money, you can just paper trade. And it's like imaginary trading. And it allows you to kind of get a groove going on and learn how it works without actually taking real monetary risk. So do yourself a favor and paper trade your trading plan for a minimum of 90 days, but I would suggest more, before placing your very first real trade. And of course, remember, friends, you never want to trade money that you cannot afford to lose. It's very, very important that realize trading is something that it's an activity that you can do to create income or to boost your account balance. But you always want to remember that that's a speculative activity. So when it comes to my own situation, I will trade maybe 10 to 20% at most of my total amount of money that I have in the market. And the rest is dedicated towards long-term investing. So trading is just an activity. It should not consume your entire account, in my opinion. After doing it for many years, I think it's a great side activity that you can trade around your core positions, but be cautious of literally only trading and not having any kind of long-term investments. I think that's something that we might even create that as another rule, maybe like a bonus rule, limit the amount you trade and allocate a certain part of your total dollars to trading. But again, I would keep it very, very low. And the newer that you are, I would keep it even lower, right? So only raise it after you have experience, right? Our goal and our aim here at Follow the Money is to see you succeed. We want to see you succeed. We're not here to help you get rich quick. We're not here to teach you how to, trade in 3 days and the next thing you know, you're a professional trader. This stuff takes time, right? But once you learn how to ride a bike, oftentimes you don't forget it. And once you learn a skill or a trade, it's something that you have for life. And that's what we want to teach you here at Follow the Money. That's what we do with our members and students. We teach them every week through our weekly webcasts, our weekend trading and investing reports that we put out, and our daily trading ideas, our daily digest where we put out economic and investing ideas. Just a lot of stuff that we do for our members here. So if you're interested in learning more about our work, simply go to followthemoney.com/join, and there you can view the different plans. And I hope to see you on the other side. All right, friends. Well, this has been a great episode. I'm so grateful that you've been here for the entirety of today's broadcast, and I sure hope you've learned a lot from these top 10 trading rules. These are rules, again, that I've been using for years, and I sure hope that you find some help in them for your own trading. And I also want to remind you that we are doing a live weekly webcast every Tuesday morning for all of our members here at followthemoney.com. And if you're wanting to learn more about trading, you really want to pay attention, because we are getting ready to launch a complete position trading course and swing trading course on those live Tuesday calls. So it's a perfect time to join at the beginning of 2024, especially if you're looking to learn more about trading and investing this new year. I want to encourage you to come and check us out, followthemoney.com. Now, as always, I like to leave you with a final word, this time by the famed investor Warren Buffett, when he said, "The market is a device for transferring money from the impatient to the patient." I got to tell you, that's a very true statement. Impatience is a very expensive trait when it comes to the markets. Learning to be patient and wait for the right opportunities pays handsome dividends, and that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.